Okay, good afternoon, everybody, and thank you for joining this Invest Engine webinar in partnership with JP Morgan Asset Management on their Research Enhanced Index ETFs, or REI ETFs for short. I'm Andy Prosser. I'm the head of investments at Invest Engine, and I'm joined today by Ted Malcolm, who's the head of UK ETF distribution for JP Morgan Asset Management, and Rory Hill, who's an investment specialist also from JP Morgan Asset Management. So welcome to both of you. Now, in terms of the plan for the webinar, I'm going to hand over to Ted and Rory in a second, and they're going to go through a presentation on these new ETFs. That should last about 30 minutes. I'll then give a quick wrap up and run through how you can buy the ETFs on the Invest Engine platform. And then we should have about 5 to 10 minutes at the end for some Q&A. Now, if you do want to ask questions as we're going through the presentation, you should be able to click on the Q&A button in the bottom of the screen. The questions won't be broadcast to the whole webinar chat. They'll just come straight to us. So don't worry if you think you've got a stupid question. That's absolutely fine. Feel free to ask away and we'll answer as many as we can at the end. So if we just go on to the next slide, please. We've got the disclaimer here that your capital is at risk whenever you invest. This is for UK residents only, and that none of this is financial advice. So with that, I'll hand over to Ted to get us kicked off with the presentation. Over to you guys.
Thanks, Andrew, and good afternoon, everyone. Great to be here. Thank you very much for taking the time to dial in. So as Andrew said, we're both from JP Morgan Asset Management. My name's Ted. I look after the UK ETF distribution team, and Rory Hill is an investment specialist sitting with our investment team that is the brains behind a number of the ETFs that we're going to talk about today. Before we go into the individual actual ETF investment strategies, we want to spend just a couple of minutes on the concept of actively managed ETFs. Now, this might be a new concept to a lot of you because it is still quite a new phenomenon in the ETF space. As many of you know, most of the ETF market for the last 30 or so years has been based around passive investing, index-based ETFs, which is great. However, in the last few years, people like ourselves at JP Morgan have started to deliver some of our active capabilities, but via the ETF vehicle. And if we can go on to the next slide, we can kind of bring that to life a bit in terms of what we really mean here. So as I said, on the left-hand side, most of the market still sits in the passive space. And as you all know, a passive ETF's job is purely just to replicate a particular index. They do their job perfectly. They have very little tracking error and give you that market exposure at a low cost, which is great. There is a slight differentiation with passive when you move into smart beta. Again, this is still index-based, rules-based, systematic. It's just tracking an index that isn't market cap weighted. And again, these have been very popular over the last few years. Where we come in is on the right-hand side, so in the active space. And what we mean by active is that we have active investment teams behind the scenes who are looking with the investment objective of outperforming or providing excess return above and beyond our reference benchmarks. There's lots of different ways of doing this, and there's huge amounts of sort of intel that goes into this, and we can discuss some of that today. But what we wanted to really get across today is that ETF doesn't equal passive anymore, that there is now active opportunities for you guys to go to Invest Engine and access these active strategies. It's still very early days for this market, but it is growing incredibly quickly. Active ETFs only make up about 6% of the overall market. But are capturing a lot of the flow, something like 25% last year of all the flow going into ETFs is now going into active ETFs. So what that means for you as investors is that there should be more choice available to you to look alongside both passive options and now active ETF options. Now, if we flick to the next slide, we kind of want to bring it to life as to sort of why consider an active ETF? You know, obviously passive ETFs do a phenomenal job, and they have a lot of benefits. But we think there very much is a place for active ETFs in your portfolios. And some of them are articulated here on this slide. The way we think about it at JP Morgan is that it's almost like the bringing of two worlds together. You've got the ETF vehicle, the ETF technology, and then you've got the active investment insights that go into that. And so hopefully you as investors get the best of both worlds. You get the benefits of the ETF vehicle, and hopefully you all know those benefits, things such as attractive fees, very easy to access and trade via the likes of Invest Engine, and transparency. You get to see exactly what is in the portfolio on a daily basis if you want, and that's whether it's an active or a passive portfolio. So you have these benefits, and now we're offering obviously active investment strategies via that vehicle. And as I said earlier, hopefully the aim of an active investment strategy is to deliver excess return above a benchmark, but also controlling risk and making sure the solution is very well diversified. And so that's the kind of genesis of active ETFs. It's nothing really new for us in terms of a lot of these investment strategies we're going to talk about today. We've been running in all sorts of different vehicles, whether that's mutual funds or trusts or separate mandates. It's now we're just giving those investors who like ETFs the option or the access point to go and get access to these strategies via the ETF vehicle. So that's the kind of very high level summary on active ETFs. What we want to do now is bring in Rory to maybe talk to bring to life some of these strategies that we're running. The ones we're going to talk about today are called research enhanced indexing ETFs. And they've probably been our most popular range to date since we launched our ETF platform about 6 years ago. So really popular and hopefully offer you something a bit different to what you're used to. But I'll let Rory go into that.
Great, thanks a lot, Ted. And so on the next slide, and again, thank you. Once more, maybe. There we go. Thank you. And if we could maybe bring up all the images on screen, that'd be great. Thanks so much. And so, Ted, thanks again. As mentioned, we're talking about active ETFs. So I guess the first question is, are these ETFs really active? And of course, we say yes, they are. So these sit in our researched enhanced index strategies. And what these try to do is these ETFs are designed to look, feel, and sort of behave like the index, but we're trying to enhance the returns of these products using bottom-up fundamental research. So these products really are the best of passive and active together in one product. All the benefits of the ETF wrapper, they look and feel like many of the passive indices you're used to using, but we're trying to use all of this fundamental research that we do to overweight stocks we like, underweight stocks we don't like, to try and outperform the index. And we can come on to how we do that a bit later. But I think what this graphic does is illustrates it quite nicely what we're trying to do. If you look on the sort of left-hand side, you've got a picture of a town, and on the bottom left, you've got a picture of a street. On the right-hand side, you've got two different gardens. Garden top right, obviously a very nice garden. Think of that as a good investment. And the bottom right is a bad garden. Think of that as a bad investment. So what we're trying to do is we are trying to spend more time in the good gardens or invest more in the good stocks and spend less time in the bad gardens or invest less in the bad stocks. But do that in a way that from a top-down basis, from the picture of the town and picture of the street, it looks very, very, very similar. So if we go to the next slide, we can see how that actually looks in action. So this is our Global Research Enhanced Index ETF. And what we're showing here in blue is the weights of this ETF, sorry. And in yellow is we're showing the weights in the benchmark, which is MSCI World. So if you look on the left-hand side, and just like from a town, the snapshot of the town, it looks very similar. The regional weights of this product versus MSCI World is exactly the same. Now, if we were to show you the same for the sector weights, again, it would look the same again. Very, very similar weights versus the benchmark. Now, you might say, aha, Rory, but okay, what about within region? Are we still sector neutral within region? And that's what you can see in this sort of middle bar here. We've taken the sector weights within our Europe allocation, within the global product. And you can see the weights are very, very similar versus the benchmark. So this tells you that we're not overweighting regions, underweighting regions, overweighting sectors or underweighting sectors. Where the difference really comes in is at a stock level. And that's what you can see on the right-hand side. And we've used the European retail sector as an example. And you can see on the far right-hand side, the names that we like the most. LVMH, so they're a luxury goods company, own many of the luxury goods brands that you might know. Tesco, I'm sure, will be very familiar to many of you on the call. And on the bottom of that chart, you can see some of the names that we don't think are as good investments as the others. Hermes, Kering, Moncler. And the beauty of these products is we're doing this in every sector, in every region. So these products really capture as much of all of this exciting fundamental research that we do, and does it in a way which keeps the product region neutral and sector neutral. And if we go on to the next slide, I'll just expand on a few points we've made already. Ted mentioned that these ETFs we launched initially in 2018, but the underlying strategies themselves are really not new to us. They actually date back to the late 80s in the US, and we've been managing money in this way globally since 2003. And typically, these sorts of strategies were reserved for very large institutional clients. So think pension funds, insurance companies, foundations, endowments. And as Ted mentioned, what's been really exciting for us has been packaging these products in an ETF wrapper. And what we can see here is the performance profile of this strategy. And this is exactly what we would expect for the ETFs. The ETF was launched 5 years ago. If Ted and I are lucky enough to do this call again in 15 years' time, this is what we think the returns of the ETF would look like. The top bar, you can see the excess return. So you can see very, very, very consistent excess return over 5-year periods, quarterly observations. The middle bar, you can see tracking error. Very, very, very consistent tracking error. Now, tracking error, of course, is a measure of how much risk we're taking. How different are we from the benchmark? Typically in active products, you might used to be seeing very, very high levels of tracking error. That's not the case here. Very low and consistent levels of tracking error to try and generate low but positive excess return. And a measure we use to try and judge how good a job we're doing in the industry is called the information ratio. And that's your excess return divided by your tracking error. And you can see the information ratio on the bottom of this chart. Anything above 0.5, academic textbooks will tell you is very good. Anything above 1, very good. So we're very, very pleased to be able to offer this sort of strategy, which since its inception in 2003 has had an information ratio of 1.3. We're so excited to be able to package this sort of strategy in an ETF wrapper. So if we go to the next slide.
Yeah, and I suppose a question for you, Roy, is that, this is obviously phenomenal numbers. I think an information ratio above 1 is generally considered very strong when it comes to academia. So obviously it's had a consistently very good information ratio. It's also worth noting, we'll probably discuss this in the Q&A, because we're not offering huge amounts of excess return, but albeit consistent, our fees are pretty attractive. So we're not eating into that excess return with much fees. The fee on this is only 25 basis points, but we can touch on that later. But what I want to know is kind of what's the team behind this? How are they being so consistently with their excess return and obviously managing that tracking error so tightly? Could you talk a bit more about the team behind this?
Yeah, absolutely. So let's jump onto the next slide. Perfect. So obviously the sort of clue is in the name, right? Research. Fundamental research is the real engine of this process. And if we take a step back for a moment and think about JP Morgan Asset Management, we're predominantly an active house. And underpinning essentially all of our active capabilities within equities is a fundamental research team of 90 career research analysts based all around the world. And collectively, they cover over 2,500 companies. So all of the big, large companies around the world that are investable for investors like us, we cover. And collectively, we spend over $150 million a year on research, which is a big, big, big number. So this is a big, powerful research platform, we think. And what unites all of these research analysts is a focus on long-term earnings. So the job of these research analysts is to cover between 25 and 30 stocks each within their sector, within their region. So for example, we've got a US autos analyst, we've got a European autos analyst, we've got a Japanese autos analyst, et cetera, for all the different sectors. And they're trying to forecast long-term earnings. And it's very, very hard to do. But we think we've got the right team in place, the right resources to try and get this right. And they're using these long-term forecasts to try and essentially figure out what we think are going to be the best investments and the best stocks to be positioned in over the long term. And what the portfolio managers in these strategies are doing is they're taking the insights from this research team, and we're overweighting the names that the analysts like the most, underweighting the names that the analysts like the least. So if we think back to that earlier slide, it's only names like Tesco and LVMH and less of the other names. So it's a big, powerful platform, one that we're very proud of, and one that obviously we're very lucky to have to be able to manage these sorts of portfolios.
No, thank you. And I think one thing that comes up often in my client discussions is a lot of big financial firms like ourselves go out and tell the market, yes, we have wonderful people and great big businesses to support these products. And yes, we do that, and we do have that, which is fantastic. I think what sets us apart and why these products have been so successful based off this research is that those 90 research analysts that Rory was going through, what's quite unique with us is that we make them career research analysts. Often in other industries or other financial firms, a research analyst will spend a few years when they start off in the industry and then look to become a fund manager or portfolio manager at some point. We actually make this role incredibly senior and important at JP Morgan. So often these research analysts have got decades worth of experience, often covering the same stocks. So they know these stocks inside out and obviously have great access to the CEOs, CFOs. So really have unique insights, which is then inputted into the portfolio. So all of this sounds great. And obviously we saw some of the numbers from the global one. We obviously have a broader range of ETFs that follow the same strategy, but is relevant to different regions. Does all this work in every region, or is it just global? Could we have a look at that?
Yes, absolutely. So maybe we jump forward another slide as well. Brilliant, thank you. So yes, you sort of hit the nail on the head. All very well, us talking about conceptually, what are these products trying to do? I showed you some of the returns of the strategy, but what about the ETF? That's obviously what we sort of care about. And this data here you can see is of our ETFs. And as you rightly mentioned, so far we've spoken about our global ETF. We call it JREG, and it's benchmarked against MSCI World, and you can see that up at the top left. But that was actually one of 4 products that we launched back in October 2018. We launched a European product, which you can see at top right, JREE. We launched a US product as well, JREU, bottom left, and an emerging market product, bottom right. And since then, we've actually launched a number of sort of new flavors or new iterations of these products. And the idea is that we should have core building blocks for all of the major regions and sort of countries out there, so that you can access exposure to these countries and regions, but using this researched enhanced index product or solution. And again, if we sort of stick to the example up on the top left of global, pleased to say that performance has been very, very strong. The numbers here you see are annualized and net of fees. So in the global product, we've delivered 1.14% annualized since inception at a tracking error of 0.66, which is sort of low and consistent. And again, remember, one divided by the other gets you your information ratio. An information ratio, again, is sort of a good measure of thinking about how hard your money is working for you. I think a really interesting thing also to take away from these slides is it really articulates and demonstrates what these products are trying to do. They look, feel, and behave like the benchmark. So at the very outset of the life of these products, you can see the product in blue and the benchmarks in yellow. They're sort of very, very similar to each other. You can have to look at a magnifying glass to try and see any differences between them. But what we're trying to do is generate low but positive excess return. And over time, that should compound into quite meaningful differences versus the benchmark. And you can start to see the jaws between the blue and the yellow line start to get bigger and bigger, which, as you can see, for global, Europe, and US has been extremely strong. Emerging markets has still outperformed net of fees, but to a much lesser extent than some of the other regions. It's been quite hard to generate alpha in that sort of market in recent years, if we think about all of the headlines that's been impacting this sort of region. Perhaps as a sort of follow-up point to that is, when do these products work and when don't they? These are fundamentally driven strategies. So when fundamental research works, we think these products work really, really well. And that tends to be in the majority of environments. But clearly in emerging markets, it's been a much harder environment. And the really interesting thing is that actually moments of sort of greed, fear, panic, lots of uncertainty tends to open up quite powerful opportunities for us as sort of active investors, because it allows us to take advantage of these opportunities. And we're seeing a lot of those opportunities now in emerging markets.
And it's probably just worth reiterating, because as we know, as I said in my opening comments, most of the market, has historically in ETF land been passive investing. And so for those of you on the line who use a lot of passive ETFs, which I'm sure is the case given the Invest Engine's sort of focus on ETFs, what you'd be expecting to receive from a passive investment is that yellow line. And so we're not a big departure away from that. So it will still look and feel, these products, very similar to what you're used to from a passive perspective, but just give you that incremental excess return that Rory was talking about. And I know some of these numbers on the screen don't look particularly exciting, like 1% excess return. But as we know, the beauty of compounding over time, as Rory said, the jaw between the blue and the yellow gets wider and wider as that compounds through. So yes, maybe the first year relative to the index, it does a job and it's giving you more. But these should be held as long-term strategic asset allocation tools, like you would own a passive ETF. And over time, you should be rewarded quite nicely versus a passive ETF as well. I think we've got one more slide where we're going to talk about sort of maybe how they're being used.
Sorry, can I just jump in for a second, guys? Sorry, just on that previous slide, we had one question come in just to clarify something. You had the stat of the 1.14% outperformance in the top left there. Is that annualized? Is that every year, or is that cumulative over the whole period?
Yeah, that's annualized over every year. So if you bought JREG at its inception date, which I think was October 2018, till the end of February, which is when this data is cut, you would have seen 1.14% excess return versus the benchmark annualized. So a cumulative number is obviously bigger than that, and that's the sort of difference between that blue and yellow line. So just to build on sort of Ted's point, not crazy numbers. This isn't going to give you 10% in 1 year excess return, but it's not going to give you negative 10%. Either. It's all about sort of low consistency and risk control.
Perfect, thank you.
Thanks, Andy. So on the next slide, maybe to sort of sum up some of the concepts that we've spoken about so far is of course these are active ETFs, but active ETFs at a very, very attractive price. Also, they're active but very low levels of tracking error versus what you might expect from traditional active strategies. Obviously, the benefit of this is this can be a really, really efficient way to invest in equities, because it can help add that much incremental excess return over time versus the benchmark. We think these are core building blocks. So we've seen a lot of clients over the last few years use these either as a replacement for some of the passive ETFs they have, or a complement, because they're very, very, very similar, but allows you to participate in some of this sort of fundamental research and excess return that we're trying to generate.
Yeah, and I'd also add to that as well, is that definitely we've seen the way they've been used, as Rory said, as an alternative to passive, saying, look, I'm willing to take on a bit more risk, because obviously there is risk involved to generate that excess return, to generate a bit more return, because the fee levels are still pretty attractive. So you see that move from passive to these kind of products, but also as a complement. But then interestingly, on the other side of the fence, we've actually seen investors who historically have used more active funds, where obviously the risk and return characteristics are a bit higher, in that you have to pay higher fees for hopefully more return. But actually, we know that that is quite difficult. And so therefore, investors who want to sit almost in the middle, where, yes, I still believe in the opportunity of active management. However, one, I don't want to pay particularly high fees, but two, I want some more risk controls. Like, this is a very risk control process. And so you can sleep at night knowing that there is tight guardrails around how much risk we can take in the portfolio, because we can't deviate too far from the underlying index. So it's a kind of either an active and down approach or a passive and up investment.
Great. So maybe back to you, Andy, to see if there's any questions we can answer.
Well, before we get to that, we tend to do Q&A at the end. But thank you. First of all, that was a really good deep dive into the world of active ETFs. Now, I'm just keep an eye on time because we need to allow a bit of time at the end for Q&A. So I am going to do a quick demo in a second. But in the meantime, please feel free, keep the questions coming. If we don't get a chance to answer them today, then we'll do our best to get back to you after the webinar. We tend to kind of copy and paste the questions and then work through them and send them back. So I'm going to start sharing my screen now, if I can get the technology to work for me. Yeah, here we go. There we go. So I'm just going to do a quick walkthrough of how to buy these ETFs on the platform. There, that looks like it's working now. So here we've got a dummy account to walk through. So basically what happens is once you are logged into the InvestEngine app on your phone or on the web browser, you can either open a new portfolio or you can select your existing one. So I'm going to select this DIY one here. It's imaginatively named DIY1, where we've got half in equities and half in bonds as target weights. You can see once it loads, if my internet can hold up, here we go. We've got 50% in this fund and 50% in this fund. So how we add securities is we simply click add securities right there. And then it's really easy. You can just click the JP Morgan banner, which appears at the top here. So we click into that. And that brings up all the JP Morgan ETFs that we have available on the platform. Now, I did see one question come through on the Q&A that says, is this just available for the managed portfolios or is this available to everybody? I.e., are all the REI ETFs available to all the clients in InvestEngine on the DIY side? And they absolutely are. This is the list of all of the JP Morgan ETFs that we have on the platform. They've got loads on there. But what we've been talking about today is the research enhanced index ETFs. So if we type in research, that brings up all the different flavors of the REI ETFs. And we've got the global one at the top there. So if we just pick this one, we can see that since the 20th of February 2022, it's up about 25%. And I did check the MSCI World before coming on this webinar, and that's up about 21% over the same period. So after costs, this ETF has in fact outperformed the benchmark. So we are simply going to click add to portfolio. And you can see now on this top right hand side there, that is now included in the portfolio. You simply click continue, and then we can adjust the weights of the ETF in the portfolio. So I'm going to take this fund out and replace it with the JP Morgan one. There we go. And here you can see, this is a really interesting bit. This is where you can do the kind of look through into the portfolio. And you can see here that these changes that we're doing to the portfolio, they slightly increase the exposure to North America. You can see it slightly increases Europe ex-UK exposure. You can have a look, you can drill down into the sectors. You can see we're slightly increasing industrial, a bit more to technology and financials. And on the individual holding side, you can see that we're slightly allocating more to Microsoft, Apple, a little bit more to NVIDIA and Amazon. And if we're happy with that, we can just click save and continue. And that should be it. It's the target weights have now been updated. And now we can scroll down and see here it is. The fund is now in the portfolio with a target weight of 50% here. So all we have to do now is fund the account if it's not already funded. But if it is already funded like this one, then we just need to rebalance to our new target weights, in which case it's just options and rebalance portfolio there. So it is as easy as that. So I'm going to stop sharing my screen now. If anybody's got any questions on any of that, please feel free to ask in the Q&A or email our support@investengine.com. They're excellent at guiding people through how the platform works. But let's now get stuck into Q&A. Right, let's see what we've got, guys. Okay, here we go. You were saying earlier that your active ETFs, they're growing really quickly. They're taking in lots of inflows. And from personal experience, I can absolutely validate what you guys are saying. I was at an industry event a couple of days ago, and all they could talk about were these active ETFs, every single panel. So why do you guys think the active ETFs have been growing so much? And do you think this trend is likely to continue?
Well, we hope it continues, but yeah, no. From our perspective, it's still early days, and we kind of want to level set with the audience that, active ETFs, as I said earlier, only make up 6% of the market. So we're coming from a low base, but we are seeing those huge growth rates. As I said, last year, over 20% of all flows going into ETFs were going into active ETFs. Fast forward to this year, I know we're only 3 months into the year, but that number's now up to 40% of all flows. So a large majority of money is now being used into active ETFs. Obviously, we've articulated why that is in terms of some of the reasons, but the great thing for you as investors is as this market grows, there'll be more offerings available to you. And so people like ourselves are going to be launching lots more active ETFs, bringing existing investment strategies now just wrapped up in the ETF. And I'm sure others from other groups, fund houses will also. There'll be more choice, there'll be more innovation. That's part of the active story, and that's hopefully where we can differentiate versus passive. You've got some great access points to passive on the platform already. Hopefully now bring some active capabilities. You can partner alongside the passive exposure that you already have. So lots more to come from us in the industry. We see it here for the long term for all the reasons we articulated earlier in terms of the benefits of the ETF vehicle, now partnering with an active strategy.
Yeah, that makes a lot of sense. I've got a question, I think probably for you, Rory, more on the specifics of how the portfolios are constructed. You can see on the platform, actually, there's a little signifier that says these are all ESG ETFs. So are you able to kind of talk a little bit about what ESG is to start with and how that's incorporated into the portfolio construction process?
Yeah, so that's a great question. So ESG is obviously environmental, social, and sort of governance. I think there's 3 different ways that we sort of incorporate that into these products, which is why there's that ESG sort of flag, if you like. The first is exclusions. So in these products, we exclude thermal coal, controversial weapons, and tobacco based on certain revenue thresholds. So in designing these products, these were some of the sort of stocks and industries which clients in these products didn't want us to hold. So we've excluded them from the into these strategies is research integration. So we spoke a little bit about how our fundamental research analysts are forecasting long-term earnings and how hard and how difficult that can be. But one of the key factors in forecasting those earnings is ESG. So all of our research analysts are doing proprietary ESG analysis to work out how ESG issues are impacting long-term earnings on the positive or the negative side. So fully integrated into our fundamental research. And the final way we sort of think about ESG in these products is through engagement. And so we hold big engagement discussions with the companies we invest in to talk to them about ESG issues. So that's why we've got the sort of ESG flag on these products.
Yeah, that makes sense. I guess that's part of the job of all these analysts that you were talking about before, right? They're meeting with these companies and engaging with management and voting and all that sort of thing.
Exactly, yeah. As when it comes to sort of forecasting earnings, a big driver of that is the ESG profile of the business, along with is it a good business? Is it a good quality business as well? So there's a lot of work that goes into that.
Yeah, so we've got a couple of related questions on cost. So one person simply asking, what are the charges? So maybe a little bit about that. And also a kind of related question is that a lot of investors have tended to buy passive funds in the past because they've historically been a lot cheaper than active funds. So maybe just to summarize, what would you say to those investors who've maybe avoided active funds in the past because of their cost?
Yeah, so it's hard to categorize all active ETFs because every single strategy is slightly different. But for these research enhanced index ETFs we spoke about today, because we have designed them to look and feel like passive from an investment perspective, we also have to make them look and feel from a cost perspective. And so these are actually very similar to passive pricing. So as an example, the global one we spoke about a lot today, that's 25 basis points all in. The US one is 20 bips.
Sorry, that's 0.25%.
0.25,
yeah.
Sorry, talking in BIPS language. And then the rest of the developed market ones are 0.25, and the emerging markets is 0.3. So some of these are actually the same as some passive ETFs out there, and we can't get away with charging them. We don't want to, because obviously the alpha opportunity is not as large. The other thing which is great for investors in active ETFs is because we've decided to go into the ETF game, we know that ETF pricing is very competitive. And so even for active strategies, we have to make sure that our pricing is as competitive as possible. So the days of the old school active managers charging high fees is probably not the case when it comes to active ETFs. So we would sort of urge you just to look at the cost and pricing. And obviously you might not agree with it, but hopefully our pricing is fairer and closer to what you'd expect.
So I've got one question for you here. I don't want to keep bombarding you, but there are lots of questions coming in. And I promise this wasn't even one of the ones that was planted. This is a totally legitimate question here. Does JP Morgan offer any active ETFs that are less benchmark aware and more aggressively active, e.g. more tracking error and higher excess return?
Yeah, we do. And so what we've decided to do, as we were one of the earlier people to launch active ETFs, we're the leader globally, is that we wanted to do these sort of low tracking error solutions first to get people comfortable with the concept of active, because it is similar to passive. But over time, we've started to launch some more active ETFs as well. So we do have quite a few more active ETFs across both equities and fixed income. I'm sure they will be also on the Invest Engine platform as well. If not, we can certainly have them added with Andy and team. So yeah, go check those out. Obviously, very different investment strategies to these. But again, still backed by JP Morgan, which is a very large, well-resourced investment management firm.
Yeah. So there's a couple of questions that I can answer here that have just come in, more kind of platform related ones. What currencies are they denominated in? Now, you guys are talking about other currencies. Obviously, at Invest Engine, we offer sterling denominated share classes on our platform. So all of the share classes on the Invest Engine platform will be denominated in sterling. And there was a second question here about the difference between the distributing and accumulating REIs that are on the platform. Aside from the obvious dividend distribution policies, the question is, do they have the same weightings? And the answer will be absolutely yes, they are identical, except for their dividend distribution policy. And I think we're actually, also there's just one question on, oh no, we've already answered that one. They're just quickly disappearing off my screen as they all get answered. Excellent, right, I think we've actually got through all of the questions then. So I can give everybody a bit of extra time back to get to the pub. So if we haven't answered any of your questions, if you do have any other questions that you want to ask, then you can email support@investengine.com, and they'll get routed to us. And if there are any questions for Ted or Rory, ask them to provide the answers for us, or you can post on the community forum, and we can answer any questions that way. So all that leaves me to say, guys, big thank you to Ted and Rory for their time today, and thank you both. And if you want to find out more about the JP Morgan Asset Management REI ETF range that we've been talking about today, then you can click the JP Morgan banner at the top of our ETF range page. That's the page with all of the ETFs listed on there, and you'll find all the details there. So thank you all for joining, and see you next time.
Thanks, Andy.
Thank you.